All right, hello everyone. Welcome to the video lecture series on capital budgeting. So, chapter 22. This is the first of two lectures, and really what we're going to focus on this lecture is just kind of the overview of capital budgeting and one way of assessing the desirability or the performance of potential projects that you're budgeting for into the future. So, let's get started. So, in general, capital budgeting is the process of identifying and evaluating, selecting, and controlling capital investments. So, what we're really going to focus on here in our lectures are evaluating and selecting capital investments. So, what are capital investments? Well, it's what you think. It's the purchase of PP&E. So we need to buy some new equipment. Is it worth buying new equipment versus old equipment? The equipment we have now, is it worth it to buy new equipment or just stick with what we have? Or maybe we're just comparing two different types of equipment that we can buy. So equipment one versus equipment two. So we have to do an analysis to see which one of these sets of equipment is more desirable. It could be the acquisition or sale of entire divisions or subunits of our company. So we'll have to evaluate, hey, is this going to be profitable in the long run if we buy it, or is it going to be profitable in the long run if we currently own it? Should we go ahead and sell this? And then also launching of a new product. You can estimate all the cash inflows and outflows for a new product and then decide, hey, is it worth us investing all this money into this new product, given this is what we think the end result's going to look like? So in general, capital budgeting, it's just kind of like what it sounds like. It's deciding if we're going to spend our capital on some big project or investment and how we're going to budget for that. So the main decision model for this is the discounted cash flow model. You guys should be pretty well versed in discounted cash flow, and the discounted cash flow can be used for NPV and IRR. So NPV is net present value, and IRR is the internal rate of return. And for our class, we're going to focus on the NPV rule because this is basically what most people use in practice. So it's going to be the one you want to be most familiar with. And like I said, hopefully you guys are pretty well versed in calculating net present values, but because it's one of those things that are really used in practice and it's a really keystone concept to understand, we're going to always hit on it over and over again in these classes to make sure you guys fully grasp it and have a really good understanding. So when you get out there in the real world, these things are second nature to you. And then another definition you're going to have to remember is the weighted average cost of capital, or the WACC. And we use this in our last lecture series, but this is usually the discount discount percentage you use in your discounted cash flow models. And this makes sense because your WACC is essentially the interest you're paying. So this is really the interest rate that you're paying on any money that you get as a loan or as equity. This is the interest rate you're going to be paying back. So that's the interest rate you need to use when you're assessing how you're going to use that money. Really, because that debt or equity, that's the money that you're going to use to make these capital purchases, to buy that new property, plant, and equipment. So you want to use that rate to discount all those purchases back. So here's just a couple examples, or a quick example to get into. So let's look at these two projects. We have Project L and Project S. Both projects require us to right away put up a $100 investment. And then Project L, at the end of year one, it pays us $10, year two, $60, and year three, $80. Project S, at the end of year one, it pays us $70. Year two pays us 50, and year three pays us 20. Well, real quick, look at that. And I'll give you about 15 seconds. Try to decide which project you think you would invest in. Like I said, I'll give you about 15 seconds, but if you need more time, just pause the lecture here real quick and think about it for as long as you want and then start us up or start it up again. All right, so you might have noticed a couple things about these two projects. And the first thing that you might have noticed is Project L, you get more total return. So overall, you get a $150 payment on your $100 investment. Whereas for Project S, you get a $140 payment on your $100 investment. So the first thing you look at, it might look like L is better, right? You make more money in the long run. But another thing you might have noticed is the big bang, the big amount you get, the big check that you're going to get from Project L comes at the very end, that $80 check at the end of year three. Where the big check for Project S, it comes right away at the end of year one. And so because of the concepts we know about discounted cash flow, that although L might be more attractive in the total sum of money, this timing of all the cash flows for both projects make S look a little more attractive. And so we're going to have to do some analysis to say, hey, if we require a 10% rate of return, or just imagine this is our 10% is our WACC. If we require 10%, well, now we can actually do a quantitative analysis and figure out which one of these projects is more desirable. So let's go ahead and do that. This is just saying the net present value. This is the actual formula for it. And this just says, hey, you discount every cash flow you receive, you discount that back at your WACC rate, and then you sum all those different cash flows up. So you have cash flow one plus cash flow two discounted back plus cash flow three discounted back, etc. This is just the calculation for it in case you guys wanted to see that. So let's look at Project L. Like we said, we have a $100 outlay. And then you get $10 at the end of year one, $60 at year two, and $80 at year three. Well, we can use our discount tables or our financial calculators. And it's easy to see or to calculate that 1 year at 10%, your discount factor is 0.909. So we multiply our $10 payment by 0.909 and we find out that that $10 is worth $9.09. Same with our 60, we discount that back by our 0.826 factor. We find out, well, that 60 in today's value is worth about $50. And then the $80, we discount that back, right? Because it's $80 that we're going to get back in the future, but we have to incorporate the interest we're going to pay when we're not getting that. So we have to not getting that money, right? Because we already paid out money for this project. So we have to discount that $80 back and say, well, what is that $80 worth at today's value using a discount factor of about 7.5? And that $80 is actually only worth about $60 in today's value. So we add all those up and we find out that Project L, it'll cost us $100 and overall we'll make about 19 bucks. Okay, so now we do the same analysis for Project S. We discount our 70 back at the same factor, discount our 50 back, discount our $20 end of year three payment back, and we see that discounted back, this is actually worth about $20. So although Project L paid out a total of $50, well, paid out in excess of the $100 that we required up front, and Project S paid out $40. Project L in today's value, even with that greater payoff, was only $19, where Project S's was about $20. So even though Project L paid out more, in today's value, project S is actually the better project. And that's all we do here using NPV is we're just going to say, hey, let's look at all of our cash inflows and outflows, and let's use all that information to figure out what today's value of this project is. And doing that for these two projects, it looks like project S is a more valuable project as of right now today by discounting all those cash flows back. And again, this is very high level, but hopefully you guys are pretty well versed in NPV calculations. So I just want to make sure to hit it hard and so we get a good reminder and a good solid understanding. So the rationale for the NPV method is all we want to do is we want to make sure our present value of all the cash inflows minus our costs is positive, right? Because all of our present value inflows minus today's costs or the present value of other costs is what our net gain in wealth is going to be. If a project is going to have a net gain in wealth, well, then we should accept it, right? So that's what this does. This lets us know that if we have these projects or division that we could take on or buy, we can discount all our expected cash flows back to today's value and make sure that that is going to add value. And if our NPV was less than zero, we know, oh, in the long run, even though we see all these cash inflows for however many years, in the long run, we'll end up losing money on this project. But as long as our NPV is greater than zero, we should be good. That means that this project is actually going to make us money. So even though the calculation is the actual mechanics of the calculation is real straightforward, right? Easy peasy. We know how to discount stuff back. We need to be aware that in the real world, it's not the mechanics of the calculation that's tough. It's estimating the risk and the cash flows going forward, right? So estimating the risk means if we think next year's cash flow is going to be, well, let's say our outflow is $100 today, and then we're estimating that in year one, we get 50 back, year two, 50, year three, 50. So the risk is saying, well, is this really going to be $50 a year, or is it a huge risk? Like maybe it's 0 to 100, right? So each year it could be 0 to 100. That's a pretty risky bet because it could mean that we get 0 every year and we're losing a ton of money. So risk is just really saying how certain are we of that we're gonna have cash flow in the future? And then the actually estimating those cash flows is also really hard. Sometimes it can be hard to even estimate this original 50. In this example, 3 years, maybe 3 years with good information isn't too hard, but imagine you have a project that you are putting out there for 25 years. Think of all the market conditions, the industry stuff that could happen, new competitors, legal. There's so many things that could happen that make it really hard to project those cash flows 10, 15, 20 years into the future. So even though the mechanics are very easy, it's easy to calculate, actually going through the process of estimating those cash flows and how certain you are that you're even going to have cash flows. So the risk inherent in these projects is what's really tough in practice. So there's really three steps to the NPV method, and that's to draw a sketch of the relevant cash flows and outflows and inflows. And that's really what we did for our two projects, right? We said at year 0, we had $100 out. Year 1, we had 50. Year 2, 20. Year 3, 70. Of course, these numbers are not right, but it's just the example. So you'll want to draw these out and show how all the cash flows, the timing of all the cash flows. And hey, maybe even we have year 4 and 5. In year 4, we have to have another cash outflow. So we have to discount that back as well. And then maybe year 5, we get rid of everything and we sell whatever this asset is for $200. We'll have to discount that back as well. So the first step is just to draw this out So you make sure you have all the inflows and outflows down on paper. And then you use your table or calculator. If we have these calculations for exams, you'll be given tables and you can use your calculator if you need to calculate these things. So then you look up your calculator tables and you go ahead and find the factors for every year and discount that stuff back. And then last is you add them all up, calculate the NPV. You make sure it's positive, and then you say, yep, let's do it, or negative, and you say, nope, bad deal. Right, so it's not too hard. Like I said, the mechanics aren't that bad. So make sure when you're doing this, you identify all of the relevant cash flows. So the three main things to always think about are project initiation. So this is all the money that is going to go into this project, all the outflows. And this includes actual cash that you need to spend to buy the equipment, or maybe you have to convert some of your current equipment. You have to add $50 to current equipment to make it usable for this project. Or, yeah, there's a lot of different things. Maybe you just have to move some cash around, and by doing that, that cash isn't usable for something else. So that opportunity cost needs to be put in there. So all these costs need to be put as project outflows during the initiation. Then we have all the cash flows during the project while it's operating. Any other cash outflows that you have to have, this is important. Make sure those are net of tax, right? Because we actually save some tax on these cash outflows. Any additional working capital requirements, if you have to add more PP&E or you have to add more money to change equipment. And then the big ones are all the inflows for the project. Hopefully the project's making us money as it's operating, and we'll have to discount those back. Again, net of tax. And then the projects at the very end is make sure we have a net of tax disposal. So we bought a PP&E, we used it for 20 years, and then we sold it. So that sale at the end of the project, you have to discount that back. And then any recapturing of net working capital investments or changes. So again, just any gains that we have on the end, whether actually it doesn't have to be gain, any inflows or outflows, other cash inflows or outflows that are associated with this project upon completion. So I've included three example problems for you to work through. The answers will be posted online on the slides. And the first one says, hey, should you buy a new car? And it really just goes through your two options, the cash inflows and outflows of sticking with the new old car, or the cash inflows and outflows with the new car. There's an example problem on a golf course. It's one project, so it's not like the first problem where you're comparing two options. On this one, you're just saying, hey, should we do this? Should we purchase this golf course or not? And there's some other stuff built in there. And then the last one, it's, hey, should we ride our bike to our work in this job, or should we buy a car and use the car? Because that's going to make us more efficient and have some changes to our cash inflows and outflows. So let's see if that's worth it. So this is what the problems look like. Decision to buy a new car or not. Decision to buy some land or build the golf course on the land. And then if we're on a paper route, should we ride our bike or should we buy a car? So make sure you work through those problems. As always, be sure to work as hard as you can through them, check the answers, and then meet with your group and make sure everybody discusses and you guys are all on board. So in this lecture, we did a high-level overview of what capital budgeting is, the types of decisions that are within capital budgeting, and then we looked at using the discounted cash flow method, specifically NPV, to compare different cash flow streams to see if one option's better than the other, or if a project is just worth it overall. And so next lecture we'll discuss one more capital budgeting tool, a simple analysis that we can use, and then we'll move on to a couple other little things. So excited to see you in lecture number 2.